Recording. Good afternoon and welcome to Banker Beware, an update on cryptocurrency and the risk it poses to your institution. As public awareness, acceptance, and use of cryptocurrency continues to rise, so do the industry-wide concerns associated with its risk. The total market cap of crypto fell from $3 trillion to $900 billion in less than 8 months between 2021 and 2022. Why was that? A lack of regulatory oversight, inadequate risk management, lapses in corporate governance, or some combination of the above? Even if your bank doesn't explicitly transact in or custody cryptocurrency, you still need to be aware of and prepared for the risks that cryptocurrency already poses to your institution. Thanks for joining us. I'm Kia Haslett, the Managing Editor at BankDirect, where I produce and edit content for the magazine and website. My areas of focus include bank accounting policy, operations, strategy, and trends in M&A. This webinar is brought to you today by both BankDirector and Baker Tilly, an information resource to the financial community since 1991. BankDirector focuses on the strategic issues most fundamental to a bank's CEO, senior leadership team, chairman, and independent directors. Baker Tilly US LLP is a leading advisory CPA firm, providing clients with a genuine coast-to-coast and global advantage in major regions of the US and in many of the world's leading financial centers, New York, London, San Francisco, Los Angeles, and Chicago. Baker Tilly is an independent member of Baker Tilly International, a worldwide network of independent accounting and business advisory firms in 148 territories with 36,000 professionals and a combined worldwide revenue of $4 billion. We are offering CPE or continuing professional education credits for this webinar. In order to qualify for credits, you must be in attendance for the full and complete webinar and participate in all of the polls. If you want to receive CPE credit for this webinar, please email Taylor Zito at tzito@bankdirector.com. Certificates will be sent out 2 to 3 weeks after the webinar. Before we get started, let me share just a few things to keep in mind. First off, don't worry, we can't hear you. You have joined this webinar in listen-only mode. We recommend that you click on the sidebar at the bottom of the screen to put the presentation into full screen mode. If you have any questions for our speakers, please note them by clicking the Q&A button found at the right side of your screen. You can do this at any time during the presentation. Once our presenters have finished with their talking points, we'll have a Q&A period where those questions can be addressed. There is no need to take detailed notes, as the presentation will be shared with all attendees within 24 hours via email. It will also be available on bankdirector.com. If you have any technical issues, you may also note them using the moderator chat feature on the right side of the screen, and we'll do our best to take care of it. Our polls today will appear in the sidebar near the Q&A button. When you've selected your answer, just hit the vote button to submit your response. Finally, the opinions expressed in this webinar are those of the individual speaker only and do not necessarily reflect the opinions of other speakers or of the entities of which those speakers are associated. On that note, let me share a little bit about our speakers today. Chris Tate is a principal at Baker Tilly and has been with Baker Tilly since 2003. Chris has more than 20 years of experience providing technology-related consulting and assurance services to financial institutions. His experience includes information technology auditing and risk management, IT assessments, IT operations management, IT strategy development, package system selection and implementation, business process redesign, and custom systems development in a wide variety of environments. Our second speaker is Russ Summers, a director at Baker Tilly. Russ has more than 15 years of experience in serving financial services, digital assets, and technology organizations. Russ helps banks navigate their governance, risk, and compliance expectations. He has led a broad array of projects, including internal controls advisory, internal audit, cybersecurity, and regulatory compliance consulting, information technology audit and risk management, vendor risk management, enterprise risk management, and SOC 1 and 2 reporting. With that, Russ and Chris, please take it away.
Thank you, Kia. Hopefully everybody's seeing my screen now as we're going through here. It's always interesting hearing yourself get introduced in your full bio, right? It's one thing to read it and you get used to it, but seeing it in there is always interesting. I'm Russ Summers. I director here at Baker Tilly's Financial Services Risk Advisory practice. Also one of the leaders in our digital asset practice. So spend a lot of time working with financial institutions as well as crypto native organizations. So as we're going through this content today, glad to answer any questions anyone here might have. He had indicated, definitely a interesting year, right? The two plus $1 trillion drop in market cap in an 8-month period. I think you'd have to have your head in the sand to not be cognizant of kind of what's happening in that space, as well as the regulatory guidance that we've received that's come out from the Federal Reserve, from the FDIC, from the OCC. So we'll talk through all that fun stuff today. I do think there's a theme that we tried to articulate here that I just want to make mention of at the beginning, and we'll maybe recap it at the end, is just, the delineation between cryptocurrency as a whole and distributed ledger technology and blockchain. Just they oftentimes get lumped together. Today we're going to hyper focus on crypto and the guidance around crypto and the things that have happened there. But don't want to get lost in the shuffle that blockchain and DLT has some pretty cool use cases that I think have already been started to be rolled out. So with that, we'll start to work through today's presentation, give Chris Tate a chance to introduce himself, and then maybe walk through the agenda.
Right. Thank you, Russ. And thank you for everyone for joining us today. I'm looking forward to spending the next 50 minutes with you talking about the topics here. Yeah, Russ, it is weird. You and I have done, it's probably close to 100 webinars in our career together, and it's weird to see your description or your bio over there. But nonetheless, we are happy to be with you today. So we can go to the next slide. We'll walk through the agenda, really 4 areas. I'm going to kick it off and start with the state of digital assets. I'm going to turn it over to Russ, and he's going to walk through the regulation as it relates to the financial institutions, and then AML and cryptocurrency as well. I'll come back in and then share a few more observations on the unique aspects of digital assets, and then we'll wrap up with Q&A as we go along here. Okay, so before we get into the presentation, we'll have our first of 4 polling questions for everyone. So for those of you following along, to get CPE credit, you're going to need to complete all these here. I'm going to read them out loud in the answers, and please submit your answers as appropriate. Question number 1, evaluating your bank's strategy in relation to digital assets, which of the following best describes your organization's posture? A, we have no exposure to digital assets and it's not part of our future strategy. B, we have no exposure to digital assets today, but we will continue to monitor the industry and regulatory environment and will consider it in our strategy once the regulatory expectations are clear. Option C, we have evaluated our exposure to digital assets and it is on our roadmap, but we are not active in digital assets yet. D, we have begun to offer digital asset products, but only Bitcoin, and have aligned our offerings with regulatory guidance. And last but not least, option E is we are a full crypto native financial institution. Okay, please enter your answers there. I'll get us into the first section, which is really state of digital assets. I'm going to start out on the next slide of just a crypto year review, right? We mentioned some of this at the kickoff. You're going to see a graph here on the right that's really represents the value of Bitcoin. As of this morning, when I was preparing with Russ for this presentation, Bitcoin, which is really the dominant coin in the market, was at $24,665. It's interesting because that was up 50% from when Russ and I did a presentation on December 7th of 2022, when Bitcoin was at about $16,000. So it's been up about 50% since the end of December through today. But I will tell you, if you're looking back in the year in review, interesting enough, right, it was down December 7th from its all-time high, 75% drop in the last 12 months. So we've had a little bit of a boost here in the opening months of the calendar year. I would say even though it may appear cryptocurrencies have been on a roll lately, right? We mentioned before, right, that the market value really took a hit in 2022, almost sliced it by 2/3. The other piece here, it's a little bit of an eye chart. You'll see the list of the coins there in the market, top 15. They represent about 80% of the value of the market cap. Interesting enough, 3 of the top 6 and 5 of the top 15 are stable coins. We'll talk a little bit about stable coins as we go through the presentation. But they're becoming a great way for individuals and companies to send money around the world almost instantaneously without the friction that are associated with historical payments. But they also don't have the volatility that the other coins may have in the market. So you're thinking, again, think about stable coins and the volatility there. If we hit the next slide, you can see, you've probably read a lot about this in the paper, right? There has been a ton of bad news after bad news in the past 12 to 18 months, which has really driven what we'll call the crypto winter, and it really cooled the markets in 2020. I would imagine you're all familiar with what happened with FTX, which is continually evolving. I was doing some preparation for this this morning. I'll just highlight what I saw in the press today, just as it relates to FTX. Most of the press, they've been talking about Sam Bankman-Fried, or what they call SBF is his acronym, right? His internet usage, posting of his bail bonds. I think it's really interesting that the judge last week ruled that they would not authorize an independent examiner to probe FTX's, quite frankly, a spectacular failure. Basically, the judge has taken the view that they didn't want to spend tens of millions of dollars on an outside examiner to let the public know exactly what went wrong. I think that's really fascinating. If you look at other major disasters like the Enron scandal that happened a while ago, right? When you call an independent examiner in, instead, really what the focus here is going to be really on the recovery of the assets for the FTX customers. I think, again, this will be something very fascinating to watch as this continues to play out here and the details keep unfolding. So a lot of bankruptcies in 2022. If we go to the next slide, some more bad news, right? Lots of lawsuits, fines, and enforcements. I don't want to spend a ton of time on this. Again, if you were to just Google this, you will see a lot of activity with the SEC and the different regulatory agencies right now.
Chris, I think the biggest thing to talk about here, though, sorry to jump in, right, is if you look through, BitMEX was there, Robinhood, Coinbase, some of the largest fines that you saw on each of them and largest enforcement actions, they were all anti-money laundering related. I mean, Coinbase had the insider trading thing that the SEC looked into, but the $100 million settlement in January was AML related. BitMEX was AML related. Robinhood was 30 million of AML related fines. So again, talk about unregulated environment or whatever, but still the same FinCEN, Treasury regulations carry. So
no, that's a great point, Russ. I was going to quote an article. I was doing some searching before this. So an article that I just read on Bitcoin. In the title, this was last week, right? U.S. crypto lawsuits reach an all-time high with 42% increase in 2022. There's some recent headlines related. February 9th with Kraken was, forced to settle a $30 million charge with the SEC. February 13th, crypto firm Paxos was facing SEC charges. I think the punchline here, and Russ had a really good punchline there, right? There is a very critical eye on all things crypto right now, and the regulators are starting to crack down heavily is really the punchline. Move to the next slide. Large bank investments in DeFi and blockchain. So I'm going to stop a little bit with the bad news, and let's turn it around and start talking about some of the positive thoughts right now. You take a look at the chart in the slide. It's a little bit of an eye chart, but you'll see the major banks are investing heavily in this space. You can see the dollars there. I think you'll get the presentation afterwards. But the punchline here is that people and companies are still building. and they're getting better. Sure, we've seen a lot of lessons over the last 12 to 18 months with Celsius and more recently TX, but my view of these lessons is, of these situations, that the lessons are learned, and people are really bullish on this. I think the technology that supports the ecosystem is here to stay, and it keeps getting better. And we'll talk about how those things are changing over time. A couple other examples, maybe before we go into the polling question or on the major players, right? Bank of New York Mellon last year, October, announced their digital asset custody platform is live. US Bank announced in October that they were launching a custody platform as well. Another one that you won't see on here, I think this is really interesting, is MasterCard, right? They're launching a program to help financial institutions offer cryptocurrency trading and payments to their clients. So basically, I find this fascinating, right? They did a survey and found that 60% of the respondents would rather test these markets with existing banks. What does that tell us? They want to do us with trusted partners. So again, I would say here, you look at the major banks, they're investing, and people are still wanting to get into this space. The technology, I think, we're bullish on. But they want to do it with trusted partners and trusted institutions, which a lot of the banks are. I know Russ is also going to talk a little bit more about the trends with central bank digital currency a little bit later. He mentioned it at the beginning as well. So with that, we'll go to our polling question number 2. Which of the following best describes your level of familiarity personally with digital assets ecosystem? A, I think I know what Bitcoin is, but I'm not sure how it works or why it's worth anything. B, I understand at a high level how digital assets work, but I have not interacted with that marketplace. C, I have dabbled in digital assets, but I am no means an expert. D, I have an active digital asset portfolio and I engage in the market regularly. And E, I am the founder of Bitcoin. Satoshi Nakamoto. Expecting to see a lot of E's there in the answer here, so this should be interesting.
Everybody's eyeing Spartacus moment.
Yes, absolutely, Russ.
So as we give the last few seconds here to finish up responding to this polling question, the next section we're going to jump into really drives home kind of the current state of regulations, what the different regulators have said over the most recent 12-ish months, and kind of where that leaves us today. So let's start by saying, look, the crypto industry is largely panned as being this, Wild West unregulated environment. And to a certain extent, that's completely accurate. There is no centralized oversight body that encompasses all of cryptocurrency. There is no comprehensive rule set that explains how centralized and decentralized exchanges are supposed to behave. 100% accurate. I do think that there's more touch points with regulation than maybe we want to believe that there are, between exposure to the futures market and regulation by the CFTC, regulation of public companies, public Bitcoin miners, public companies that own their holding companies for Bitcoin exchange or cryptocurrency exchanges, having exposure to the SEC as a public company, not necessarily as market infrastructure, but still, through that same regulatory body that oversees market infrastructure, but in a public company lens. You've also got banking regulators that have taken notice and governed, obviously, this industry's exposure points to cryptocurrency and really the on-ramps and off-ramps to retail investors. To Chris's point about 60+% of people wanting to dabble, but wanting to do it through a trusted partner. Most of those folks were waiting for financial institutions to give them the on-ramps and off-ramps, which largely have not happened yet. So again, regulators playing their part in there as well. But there is some, right? So let's take a quick look through the existing guidance as it relates to cryptocurrency and financial institution space. So starting with the Federal Reserve, essentially saying, hey, not banning institutions from participating in crypto, but just be cognizant of the risks, right? There's the technology and operations risk. There's consumer protection and continuing to act in the best interest of customers and retail investors, financial stability, and then, of course, the anti-money laundering and counter-terrorist financing pieces, which that never goes away. Again, making sure that crypto activities are legally permissible, and this is going to be a theme throughout all the regulatory pieces that we talk about. Notification by supervised institutions that the institution plans on working in digital assets and cryptocurrency space, meeting with your direct contact at the regulatory agency, and then being able to explain the who, what, when, where, how, and why for those activities. The other piece I'm sure everyone knows, the Federal Reserve starting their regulated liability network with about a dozen or so institutions trying to sandbox and figure out how a central bank digital currency would work in the United States. That conceptually has been in the works for a while, but launched in November alongside India's central bank digital currency, which I believe also launched as of November 1st. And then the other major country that has a CBDC pilot ongoing is China, which I think this year they expanded to all of their major provinces, and I think they're probably the furthest along down that path. I did note here that Custodia, they're a crypto bank, essentially crypto native financial institution. They applied to be part of the Federal Reserve System in January and were unanimously rejected. So when looking at kind of the Federal Reserve's guidance as far as, hey, you can participate, but here's what you have to be cognizant of, and then the way that they've rolled it back now, I think they've realized the systemic risk. We'll talk in a minute about the January 2023 combined memo with the FDIC and OCC and what they said there. But definitely you kind of watch their guidance evolving as it goes. Next, on the FDIC, again, you'll see again here, any institution that's FDIC regulated, notify of engaging in crypto activities, let us know the who, what, when, where, how, and why, what you're trying to do. They put out a fact sheet in July of 2022, just clearly articulating that, FDIC deposit insurance does not apply to financial products, including crypto. FDIC deposit insurance does not apply to losses from theft and fraud. They are addressed by other laws. This is important because there were institutions that were looking to offer crypto products and talk about, exposure to digital assets and introducing new product types. And because customers, don't necessarily know, that deep the FDIC's laws and kind of applicability of the depository insurance, when you're dealing with a FDIC insured institution and you're dealing in those products, there could be this conflation that says, hey, well, they're FDIC insured, that's safe, I should go and invest in it. And the FDIC made sure they clearly articulated in that fact sheet that, hey, yes, you are, but this coverage doesn't apply, and here's why. Put in a piece of current event news here that, Levelfield acquired Berling Bank and is attempting to become the first FDIC insured bank to offer crypto products. Again, I'll defer back up to the FDIC's fact sheet about what is or is not applicable and the potential concept of false assurance in that space. What winds up happening as far as, FDIC coverage and, examination and status for that institution, we'll see. But just kind of wanted to make a note of what's kind of happening in that space now. So the OCC, in my opinion, kind of the most forward and open guidance amongst financial regulators, issued interpretive letters 1170 and 1174, basically saying, custodial services were okay for OCC covered entities. In interpretive letter 1170 and 1174 was talking about independent node verification networks and stablecoins. So definitely was the most open in saying, yep, these are permissible per those interpretive letters. Since then, the commentary has been more on the careful and cautious side to really roll back and say, look, if an institution is going to perform these services, it shouldn't be their first endeavor into providing those services. Essentially, if you provided custodial services on a wide scale and have a good custody program. If you're going to do this, make sure all applicable controls, all regulatory expectations are met in that space. And again, I think their guidance will continue to evolve. I referenced this earlier, the January 3rd, 2023 joint statement, just talking about how fraud and scams and issues amongst the crypto space, which was on one of the earlier slides. They reference it as a quote unquote contagion risk within the sector, noting the interconnectivity and interreliance among market participants, either through ownership interest, direct/indirect relationships, investments, and related party transactions that can much more significantly impact that industry than other industries. So just a word of caution out there, and I think that's a pretty impactful statement when 3 regulators come out to kind of jointly say, hey, we know what we've said to date, but we're imploring you to be cautious and have a very measured approach yet again and be aware of this quote unquote contagion risk. Looking at the future of crypto regulation, there are 2 bills in various stages of legislation in the U.S. There's the Digital Commodities Consumer Protection Act, the DCCPA, sponsored by Debbie Stabenow and John Guzman, and as well as the Responsible Financial Innovation Act, which most folks just refer to as Loomis Gillibrand. Both of those, again, going through the legislative process, depending on how things shake out in Washington and whatever is definitely not my game. I have no crystal ball, and that's not my bailiwick. So I will leave that to someone that's smarter in that space than me. But just knowing that there are 2 pieces of legislation that are ongoing internationally. Again, the Basel Committee endorsed, global crypto banking rules to be implemented by 2025. Talks about certain exposure levels, 1%, 2%, what the impact would be across the banking industry globally. The EU has their MiCA, which was due to be voted on in January. That vote got pushed to April, largely due to translation delays, trying to take 400 plus pages of legislation and translate it to 24 native languages of the EU. Seems to take a little bit more time than folks anticipated. But even if that vote goes through in April, you're still looking at potentially 12 to 18 months of interpretive guidelines, implementation guidelines before anything really hits. So, at earliest is 12 months, that's April of 2024, 18 months, you're looking at year end 2024, and then there's likely going to be a staged implementation once they go live. So, you're still looking at 2025 for anything kind of real and tangible to happen in force. But it's coming, so that's a step in the right direction. So we talked earlier about, those couple of big enforcement actions, and most of them centering on anti-money laundering and crypto. Some interesting facts in here. We're just going to kind of run through them. I think there's a few takeaways that I'll recap at the end, but primarily, the volume of anticipated, expected, perceived anti-money, money laundering within the crypto space versus traditional finance. I think there's an interesting factoid there, as well as we think about the concept of virtual asset service providers. So FATF initially issued the global standards for AML legislation 2014. They outlined specifically the concept of a virtual asset service provider, or a VASP, articulating that VASPs need to have compliance officers. They need to do regular, they need to have a KYC program. They need to monitor for suspicious activity. They need to report suspicious activity. So again, this should all sound familiar. KYC, ongoing monitoring, SARS. Those were the standards for virtual asset service providers as they were pushed out. Further down the line, they identified the increased risks associated with cryptocurrency, noting there's a high degree of anonymity. Crypto transactions allow a lot more anonymity than traditional non-cash transactions, the ease and speed of cross-border transactions, the AML and CTF risks are exacerbated because of the worldwide reach due to surveillance and enforcement abilities. Again, lack of centralized oversight. So they said, look, we get this is going to be hard. We'll issue some guidelines about what folks should do and try and see how the market evolves from that point, which it has significantly. Pulled a few data points here on VASPs, right? So again, FATF said they need to have KYC programs, they need to have ongoing monitoring, they need to file SARs. Looking back at a 2020 report, so this was rear looking, I believe these stats came out in late 2020, early 2021 by a service provider called CipherTrace. But if you go to their website, they have a much larger presentation on this. But when you look at the KYC program quality amongst virtual asset service providers broken down by region, you've got Africa, Europe, North America, Latin America, Asia Pac, and the Middle East. The best case is that 50% of those VASPs, virtual asset service providers, had strong KYC programs, right? That's about half. The interesting part about VASPs that I'll drop is a lot of these virtual asset service providers, not only do they have that mandate, right, they're also not that easy to identify. So when you're looking at your institution's exposure to cryptocurrency, I know our first polling question was about organizational exposure and types of programs. I just wanted to drill this down for a minute, right, in that a lot of these virtual asset service providers, they have DBAs that they do business as, right? So not uncommon for businesses to have a corporate name or a holding company name and then be doing business as another name. But where this gets interesting is just understanding the flow of funds from an institution to these virtual asset service providers. Your normal name checks and things like that aren't necessarily always going to work. And I'll give you an example. Not that this is a bad organization. They're fine. To my knowledge, other than the recent SEC activity, but Kraken, they had an issue relating to Ethereum staking, I think it was with the SEC, but their parent company name is Payward Inc., right? So if you had a list checking, name checking application that looked out and started looking for Kraken, you're not going to see it because most likely it's going to go to Payward Inc. And just understanding the fact that a lot of the tool sets that are in place right now and financial institutions are great for what they are, but with this new environment and virtual asset service providers and the names of those organizations and then the impact of the DBAs and the holdcos and things like that, just making sure that there's a tool set there to understand kind of the overall exposure. Because I'm not trying to shake the tree too hard, but I think for everyone that says, hey, we're not involved in digital assets, it's like, well, that's a relative term, right? We're not voluntarily involved in digital assets and offering cryptocurrency products. I think that's an easy statement to make, but, we're not source of funds for, funds entering the cryptocurrency marketplace. I think is definitely a different statement to make. And I think it's a very hard one to make. So, not trying to soapbox or pontificate, but just something to be cognizant of. Is there money laundering in crypto? So most recent data we have was from a 2022 issued report looking back at 2021 data from Chainalysis. They noted that there was approximately $8.6 billion in crypto anti-money laundering in 2021, which is a 30% increase over the prior year in 2020. As well, billions of dollars worth of crypto are transferred annually from illicit addresses. The majority winds up from a very small number of services, many of which appear to be purpose-built for money laundering. So it's not like there's this, at least their perception is not this pervasive, widespread money laundering activity. Instead, there are certain institutions that have kind of set themselves up in various venues to specifically accommodate this type of behavior. So should come as no surprise. Bad actors usually get there first. Good actors get there second and try and fix things. just seems to be the way that things work. The one interesting fact here that I want to share is just a question of scope, right? So the UN estimates that globally there's about between 800 billion and $2 trillion in money laundered every year through traditional finance. And considering there's approximately 40 trillion in currency circulating around the world, that comes out to about a 2.5% clip. If we take that same stat for crypto at the 8.6 billion and look at the 2.5 trillion average market cap over the course of 2021, right, which the all-time high was in November of 3 trillion, that comes out to 0.36%. So it's significantly less than historical methods, but that doesn't mean, and just going to caveat it, right, that doesn't mean that it somehow is inherently less risky for money laundering. I think the risks still hold true that it's more so. It's just that there's a couple of different forces. One is most of these businesses that are laundering money are largely cash intensive on purpose, right? So there is no hard and fast paper trail, and it's designed to be that way. Two, right, most of them have been up and moving long before cryptocurrency came to be. So right, they're not going to significantly shift a process that's already working because, as we all know, anytime you change a process, things break. And three being, for as anonymous as digital assets and cryptocurrency were built to be, I think people are realizing that there's information services out there that are monitoring on-chain behavior for public blockchains and private chains that they have access to. And law enforcement is subscribing to these services. Regulators are subscribing to these services, and they're wanting to gain access to the information that's available. So as much as it's anonymous and risky, there is also an increased level of transparency across organizations because everything's done on a public chain of which there's, a number of nodes that you can access and garner that information from about wallet behavior, source of funds, inbound and outbound transactions. So definitely an interesting wrinkle on something that is inherently risky, but also provides a unique perspective into activity. And then just a quick touch on the travel rule, again, an integral part of AML efforts, talking about VASPs and currency transaction monitoring, just talking about limits for transactions and noting that transactions that exceed $1,000 or certain amounts designated by member states, there has to be a record of, there has to be a screening process, there has to be a record of transactions, and be able to communicate to the appropriate parties what transactions had transpired. So lots of fun stuff. That brings us to polling question number 3. So this is number 3 of 4. If you are not currently actively involved in digital assets, which of the following best describes the primary reason why? A, digital assets are volatile and do not fit our institution's risk appetite. B, the industry is largely unregulated and would elevate our regulatory risk to the institution. C, we don't have the knowledge, skills, and experience to do so successfully while managing risk. D, we don't have the technological capabilities to do so. E, and A, we are currently involved in digital assets. And while we're talking about this, I know I insinuated it before, right? But just the concept with the virtual asset service providers and looking at customer behavior, and I'm just going to give you an example, right? So I'll save the names to protect the innocent, but when you think about exposure to digital assets in the digital asset industry, right, the question I have for every institution that I talk to is, well, how much money did you send into that marketplace during the year? And it's impossible to quantify unless you know who all the virtual asset service providers are and you understand kind of the path of transactions. And the example I'll give you is if someone were to try and go with, and again, not using any names as a good actor or bad actor, but if you're going to go with a payment processor, right, like a MoonPay or something, and let's say your institution actively blocks payments to MoonPay because you know that they're in the digital asset space and they deal with decentralized exchanges, and you're not going to let that happen. Okay. I'm just going to bring up the concept of the path of least resistance and just note that, while water innately flows downhill, there are times when it flows uphill because it has a certain amount of um, inertia, right? And then it continues its path downhill. And I'll tell you why I mention that is, okay, you block payments to MoonPay, but that person really wants to get to convert that fiat currency into digital assets, into cryptocurrency, and get it on in this wallet, right? This is MetaMask wallet or whatever. So what they can do is they then go through, let's say, Coinbase using PayPal, right, which is not a blocked payment provider, and PayPal facilitates the payment to Coinbase. And then from Coinbase, they look at their MetaMask wallet and they transfer those assets from Coinbase to MetaMask. Well, they've gotten it there. It added a step or two, but they've gotten the assets converted from fiat to cryptocurrency using an authorized payment provider that is not blocked by the institution. They've gotten them to a centralized exchange, and they've facilitated a transfer from wallet A to wallet B. That, again, the MetaMask wallet had a KYC program. The Coinbase wallet had a KYC program. They're okay talking to one another, but the payment method that was blocked because it was knowingly cryptocurrency and delivered access to the customer to a wallet that could be used on decentralized exchanges, and there's a way around it, right? So I say that, and I expound on this whole story and pontificate just to say, if you block service provider A or service provider B, that's not enough, right? So just understanding that flow of transactions and how you get from A to B, I think is truly important to understand the risk to an institution. So again, not trying to be the guy who's giving you all the scary thoughts and trying to keep you up at night, but just wanted to make sure that I kind of went through that chain of events that could get you from, hey, we're not dealing in crypto, we don't touch the crypto environment, we don't allow our customers to send money that way, to, oh, there's a way. So, Chris, you want to maybe bring us through some of the uniqueness of digital assets and what we've seen?
Yeah, absolutely. Russ, I'm going to go back to polling question number 2. We had 4 votes for I am Satoshi Nakamoto. For the record.
I love it. We should talk. Just grab coffee. I just want to hear about it.
Yeah, I just want to talk to you, right?
I'm just so naturally curious.
Excellent. All right. So what makes digital assets unique? If you look at the next slide, it's going to there's really 7 items here. And Russ, feel free to jump in when I get through a couple of them here. It is a very unique environment, right? What makes it unique? We got quite a few things on this board. I'll walk through each of them here. Lack of a comprehensive governance regulation, right? Russ talked a lot about this. We talked about what was happening in the marketplace with the regulators, with the BSA, AML, KYC things. So we know this is coming, right? We talked about that. That makes it unique, right? What's number 2? Missing table stakes of traditional finance, right? The table stakes of traditional finance are really not a given in the digital assets world, right? So BSA, AML, KYC, I could even extend it to GLBA. Right now, I think those are a challenge right now, and that makes this environment unique. There are solutions and ways you can go about being in compliance with those rules, but it's not inherently baked into all the solutions that we're seeing. Number 3, transparency and wallet activity. This is interesting because you can trace all of the transactions on the public blockchain. And there's a wide variety of products out there that will help you do that. So for example, I'll just give you a story here. You may have heard 2 of the companies out that come off the top of my head are CipherTrace and BlockTrace. So if you rewind to 2021, if you remember the Colonial Pipeline ransomware attack, I'm going to get my numbers wrong because I don't have the figures in front of me, but let's just say Colonial Pipeline, I think they paid the ransom, which is interesting, and they paid, let's say, $4 million in the ransom. Well, they partnered with one of these data products, like a CipherTrace, And working with law enforcement, they were actually to trace where all of those coins went, and they were able to actually claw back, I think there's around 2 to 2.3 million in that ransomware attack. So again, I think the transparency in the wallet activity is something that's fascinating. That is completely different than if you look at just cash and where we're sitting today. Number 4, control over the wallet keys, right? And this is interesting, right? The old adage is, hey, he, or they who control the keys control the crypto, right? If you lose that key, you do not have ownership of that crypto anymore. It's a very unique proposition, a lot different than maybe what we're used to. Market volatility, we talked about that early on. Use of smart contract. I'm not
Chris,
even sure how. Oh, go ahead, Russ.
I think this is the most interesting for me, right? So when we talked at the very beginning about, cryptocurrency does not equal DLT, does not equal DeFi, right? There's clearly inherent risks in cryptocurrency that regulators have taken a position on, and again, agree, disagree for me is irrelevant. Once they kind of come out with a ruling, that's what's to be followed. But the use of smart contracts, now granted, most of them are built, on a handful of different chains for executing, but the usability, I look back at, when RPA, AI and machine learning first came out, which again, they're still evolving technologies, but just the ability of those tool sets to comb through massive amounts of data, provide insights, identify, anomalistic behavior, problematic behavior, allow for better business decision making, whether it's operationally, sales and marketing development wise, right? That looking at that kind of technological enhancement, and then looking now at smart contracts and saying this is a way to essentially automate massively and manually intensive processes, right? One of the areas I look at, and again, I'm not aware of anybody that's specifically developing products in this space, is syndicated loans, right? Participation loans, and the manual nature of processing for those things, of intaking payments, processing the remittances, preparing the remittances, and all that, realizing that these are all contractually based. This is, unless there's a modification downstream or again, change in the participation models. Most of this is the same activity month over month, yet it's all encompassing for folks that have to perform that on the commercial side. That's something that you can factor in the contract and look through the payments and really help expedite the speed at which that stuff gets processed. Now, granted, do you want to make sure that there's good governance over that? Absolutely. There's what we've proposed and been talking to folks about with smart contracts looks very similar to the OCC's model risk management guidance, as far as rules before tools, risk assessment, documenting business purpose, documenting properties, test data sets, the equivalent of model validation, which is smart contract audit, and all those things. So you need to have that stuff in place, because it's not just you're using models to guide business decisions. You're using smart contracts, which essentially function similarly to models to actually make business decisions. And again, there's some regulatory components to that as well, especially if you were to try and use it in the lending space and things like that, where policy needs to be followed very, very closely, and you still need to look at impact and disparate impact and all those things. But the possibilities of the tech are truly what excite me there. So again, wish I had more to report on as far as practical use cases, but when I look at the space and I look at the manual nature of some of those things and the utility of smart contracts, those are the kind of things that still excite me. So I know this is banker beware, and I was the fear, uncertainty, and doubt guy earlier, but this is something that kind of gets me excited.
I just think that the syndicated loan example that you use is fascinating, right? It could provide firms ways to directly access capital markets themselves, right? Which is just fascinating to me. And last circle on here, consolidation of market infrastructure, right? This also makes it very unique, right? If you think about how transactions run, and we're going to talk a little bit about the tech stack in a little bit here, right? But the whole ecosystem can really take up the broker dealer, exchange, transfer agent, and the treasury all underneath one roof. I think that's really fascinating. It makes this unique as well. Also complicated.
And mildly terrifying.
Yes, absolutely terrifying as well. The next two slides are going to go together. Scalable DeFi stack. So I'll start here, then we'll flip to the next page. If you think about traditional banking tech stacks and solutions, they're all over the board, right? We've got our big players. We all know who they are, the FISs, the Jack Henrys, the Fiservs, and everyone in between. Integration of those technology solutions is extremely hard and expensive when you're trying to bundle solutions together to make services for your customers. The way I view DeFi tech stacks is really just building blocks that you can leverage the work that has already been done at each layer, whether it be the settlement layer, the asset layer, all the way up this chain without having to recreate the wheel. With that said, if we flip to the next slide, you'll see some examples of just different players here. And there's different players coming in and out of this DeFi ecosystem every day. It is very, very hard to keep up, right? There's some major players that have been out there for a while. When you think about this, right, a lot of costs for the solutions that institutions are providing today are tied up in big, expensive infrastructure, right? So we had used the phrase before, distributed ledger technology. The acronym is DLT, right? I would argue that you can get more resiliency at a reduced cost using this DeFi tech stack. The punchline for this is the building blocks that we're sort of looking at here in this tech stack. Institutions can really be purposeful in building products and not having to focus on the infrastructure. Why does that matter? Because it allows you to really hone in on the customer's needs and not have to have that spend with infrastructure, data centers, servers everywhere, because that's going to be taken care of you in a highly resilient manner. I think that's one of the big promises about DeFi, and when you really take a dip in here, is that the dollars and cents of building the solutions for customers is really impressive. Going to my last prepared slide here. Oh, okay, maybe another interesting thing. Mark, Russ, can you go back to it? There we go. This is another reason why it makes it different. This is just a different view of it. When you think about marketing, think about the dollars that have been thrown around as it relates to big time sports. You can see up there, the UFC or the World Cup or Miami Heat's basketball arena with FTX or the Formula One. Think about this way. Most of these companies that are throwing up major dollars in marketing are between 5 and 10 years old. So FTX started in 2019, Crypto.com in 2016, Binance in 2017. This is not a shot at Fiserv, but I am from Milwaukee, okay? And I will pick on my hometown company that everyone should know, Fiserv, right? Fiserv was founded in 1984. They put their logo on the Fiserv Forum, which is home of the great, soon-to-be NBA champion Milwaukee Bucks, when it opened up 34 years later in 2018. So just think about that for a second, right? Basically, 34 years later, Fiserv put their name on the Fiserv Forum, or the Milwaukee Bucks, but these organizations like FTX, within 3 to 5 to 6 years, you're seeing companies throw out major dollars in marketing. I think it's fascinating. They really have tech stacks. They really have built these solutions and supported. Basically, they're throwing tons of money at marketing to drive volume. They've got the solutions. Now they just need to gain market acceptance to really drive that transaction revenue. So that's interesting. Last polling question here. We'll go through this quick. After attending this session, please denote which of the following best describes your perspective on digital assets. As an institution, we are now A, more likely to include digital assets into our strategy, B, less likely to include digital assets in our strategy. D, going to discuss as a management team our current exposure to digital assets and potential required changes to our programs. Christine? And last but not least, D, equally as confident in our strategy and risk exposure to our institutions as we were before the session. Fascinating questions, Russ. Take us home in the last few minutes we have here.
Yeah, so just thinking through, right, what's next for crypto. And again, I'm going to throw this out there, and it was probably somewhere in the subscript at the beginning, but none of this is investment advice. This is just one person's view of the world. But the EU's MiCA is 2 months away from a vote and 12 to 18 months away from implementation guidance. The US is behind the EU. Basel is around the same timeline, looking at 2025. Regulations coming, but not fast enough. What's going to happen to the crypto and Bitcoin market? Again, I think your point to the approximate 50% recovery in the last 6 months or so has been remarkable. Still way off record highs, but I think we'd be remiss to not think that at some point, investors, regardless of being burned historically or good or bad, when they see potential for a return, they're going to continue to chase it, whether that's based on real value, perceived value, public sentiment, or the tweets of some social media influencer. I never thought I'd say that on a banking webinar, but that's kind of where we are today. The tech, right? The DLT, smart contracts, and distributed ledger technology, payment processing, syndicated loans, and a litany of other uses. I think regardless of what happens, whether Bitcoin goes to 0 or goes to 1 million, I think the tech that's been brought forward is going to make operations in the financial sector significantly more efficient at some point, right? Once somebody can launch it and do it wrong and fail, and then somebody else can take what they did, figure out where they went wrong, fix it, and make it right, and then really start to promulgate it amongst the industry. But how long that's going to take, I don't know. But I do know that with China and India entering into their CBDC pilots, and the Federal Reserve in the U.S. launching the regulated liability network in the sandbox, that means that between those three countries, it's about half the world's population. That's 4 billion out of approximately 8 billion people in the world as of today, that their countries, right, maybe not direct exposure to every citizen, but their countries are going through pilots for central bank digital currencies. So if that's not an indicator, I don't know what is. So, Kia, I know you've got a couple of things to take us home. I'll stop sharing my screen here and let you kind of give everyone the rest of the information they need.
Thank you so much, Chris and Russ. That was a truly informative and wide-ranging webinar session. As a reminder to our attendees, everyone will receive a recorded version of this webinar within 24 hours. It will also be available on bankdirector.com. Thank you again to Chris, Russ, and Baker Tilly for co-hosting today's webinar. I am sure if anyone had any questions they would be happy to receive them, and we can also put you in contact with them today. Thank you, everyone, for joining us, and have a great rest of your day.
Thanks, everyone.